Tesla has slashed the price of full self-driving Supervised, which is a new name for FSD, to just $99 per month in what I think is really a desperate attempt to push this technology on more Tesla drivers, generate more revenue because the core business is not doing particularly well. That's just the reality of the matter at Tesla. Deliveries were down in the first quarter of 2024. Inventory is building. Margins are declining. And when that's the case, you have to look at ways you can generate incrementally more revenue at very little cost. And for Tesla, the answer to that is FSD. So I'm going to dig into exactly what we found out last week, how it might impact the company's financials, and what to think about Tesla stock going forward. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's dig right into exactly what we found out last week about Tesla's pricing. This is an article from The Verge. The $199 per month for FSD Supervised, as it is called now, has now gone to $99 per month. And they have the tweet right here from Tesla. This was, I guess, the way that they're officially announcing these things now. And if you're not familiar, this is a level 2 driver assist program, and that's being a little bit more explicit now that it's called FSD Supervised instead of just FSD. And they had some interesting reporting along with this announcement. One is that Tesla is reportedly now mandating that service centers employees take all prospective buyers on a demo ride with FSD under direct orders from Elon Musk. That is from The Verge. But clearly there is an effort to push FSD onto more vehicles. And there are a couple of reasons for that. One, when you're selling software like this, it's incremental. Any incremental dollar in margin is going to be very, very low cost. So typically software margins are anywhere from 70 to 90%. If that's the case with FSD, Tesla could be generating another $70 to $90 in profit per vehicle per month. On an annual basis, that's going to be up to about $1,000 per year in extra profit if this gets adopted on a wider level. But the other reason is that Tesla needs more data. Data is really the key to training the model that ultimately delivers FSD. What the new AI trained neural network is doing is it's taking in information from edge cases. So when somebody brakes hard in a vehicle using FSD, they can put that information in the system, learn from it, and incrementally you learn a little bit more every single day, which you have to have hundreds of thousands, millions of miles on the road every year to be able to train that model. And even still, the FSD model is level 2. We don't know when we're going to get past level 2 to level 3 or level 4, but to have some sort of robotaxi service, which is what Elon Musk has said is going to be unveiled on August 8th, Tesla would need to be at level 5. So the training of the system behind that would be extremely important to get to level 4 or level 5. But as I have highlighted before on this channel, regulators are basically unaware. And Tesla is not testing, as that we know of, any sort of supervised autonomous driving. Everything that they're doing is a driver assist program, a level 2 autonomous driving system, and that is ultimately what they're selling. So reducing the price could potentially get it into more people's hands, but I think there's ultimately a financial motive behind this. If you look at Tesla's deliveries over time, since the end of 2022, deliveries have flatlined, and in the most recent quarter have really fallen off a cliff. At the same time, Tesla's margins have been in decline at a really, really rapid rate. Going back to the first quarter of 2022, that was when margins peaked. Tesla was making $15,675 per vehicle sold. That was their gross margin per vehicle for every vehicle sold at Tesla on average. Fast forward to the fourth quarter, and that number falls to $7,496. So more than a 50% drop in profit per vehicle for each Tesla sold. How do you make that up? Well, you could raise prices for your vehicle, but Tesla's obviously been moving in the opposite direction. So you can now add services like FSD that could potentially be a very high margin. The problem is the margin decline between the first quarter of 2022 and the fourth quarter of 2023 amounts to nearly 7 years of FSD revenue. So from a strictly financial perspective, Tesla would be better off increasing the margins on each one of its vehicles sold, because those vehicles are selling for $35,000, $40,000, $50,000. A 1% increase in margin is going to have more impact than reducing the price of FSD and trying to increase the take rate. The other thing is when you reduce your price by half, you need to increase your take rate by double to generate the same amount of revenue. So we don't yet have the data behind what's actually going on with FSD, what revenue is, what the adoption rate is, because Tesla doesn't specifically break out FSD. But this is at least an effort to move in the direction of getting more adoption at a lower price. Whether or not that will impact the take rate in the way that it would need to, or the information and the data that Tesla is collecting enough to advance FSD version 12 to where it needs to be level 4 or level 5 is yet to be seen. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. At the end of the day, I think this is ultimately a distraction from the really important things at Tesla, and that is their deliveries and their pricing. This is an automaker that needs to make money on each vehicle that it sells. And a price war, whether that's happening in China or the US or Europe, is not good for Tesla and not good for margins. And that is what has impacted the stock. This is why it's one of the worst performing stocks in the S&P 500 in 2024. And it doesn't seem to be ending anytime soon. Things like FSD and the robotaxi are a distraction for investors right now because it's not clear what the future of those products are going to be. I know there's going to be people that make comments that say, this is going to be a robotaxi company. We're not going to be driving vehicles in the future. But the reality of the situation is that Tesla is selling the most advanced level 2 driver assist program on the market today. There are other companies who are already testing and putting millions of miles on the road each year with level 4 fully autonomous driving, ride-sharing programs, an actual robotaxi that regulators have approved. Regulators don't even know what Tesla is going to try to make or try to test. So whatever they announce on August 8th is probably going to be something that isn't going to be available commercially for multiple years, because that's how long this regulatory process takes. That's how long companies like Waymo and Cruise and Zoox have been working with regulators to show their safety information, to show exactly how their systems work, to deploy it on small scales before bringing it to bigger scales. And we're still talking only about a few hundred vehicles that are on roads today. So yes, the vision for Tesla may eventually be to be some sort of full self-driving company. But right now, the stock is priced as if that is a reality today, and it's not. What is a reality today is Tesla trying to increase their profit margins by selling more software to customers at a lower price because they didn't have the demand at that higher price point. Supply and demand is the story for Tesla in 2023 and 2024. They said that they were going to increase supply of vehicles by 50% per year. Said that during the pandemic, just a couple of years ago. But Elon Musk had to back off of that because they didn't have demand to do that. That's why Tesla had to lower prices of vehicles last year and has been lowering prices again this year. And even at those lower price points, isn't able to sell every vehicle that they make. That's how you get declining revenue. That's how you get falling margins. And I don't think a lower price point for FSD is going to change that. I think what we're actually seeing is the same trends being true with FSD. There wasn't enough demand with FSD at a $12,000 price point for a lifetime subscription or a $200 per month price point. So they needed to lower the price point to $99 to get more adoption. That's why Elon Musk wants every buyer to be shown what FSD can do so that they adopt it at a higher rate, because right now the adoption rate for Tesla is pretty low. We don't know the exact numbers, but the estimates out there is that it's low double-digit percentage point. And I can't blame people who don't want to buy FSD. If you're buying a vehicle that's fun to drive, which a Tesla is, why would you want to pay extra money each month not to drive it? So I'll be back here with more Tesla analysis as we learn more, especially after the first quarter results are announced. So subscribe to Asymmetric Investing for more. Thanks for watching, everybody. See you here next time.